Good afternoon, friends. We'll start within 2 minutes. We'll start within 2 minutes. And as usual, we'll be speaking on financial management, financial statement, and ratio analysis. This is the fifth video in the series of financial management and ratio analysis. And today we are going to talk about what? वो जा रहा है? अभी आ रहा है? Now you able to hear me? Today we are going to talk about the other set of ratios. Able to hear now? Okay. Good evening, friends. This is the fifth video on financial statement and ratio analysis. Till so far, we have seen liquidity ratio, capital structure ratio, turnover ratios, and the most important part of our discussion will be on the net profit ratios, that is profitability ratios. Okay. So this is assets turnover ratio, and as we have already seen, some assets turnover ratio like debtors turnover ratio, creditors turnover ratio, and inventory turnover ratio. Let's talk about the other set of ratios, which are assets turnover ratio. Now, what does an asset turnover ratio speaks about? It speaks about how much investment has been done in assets, and what is the total turnover the company was able to do in comparison with the assets, investments in the assets concerned. So the sales, the turnover, the revenue which should be generated from total assets should be higher in comparison with the total assets. There is no fixed rule or ideal ratio between total assets and turnover, or turnover and the total assets. But higher the total turnover, total assets turnover ratio, better is the company, or better is the financial position of the company, as they are able to productively utilize all the assets which are there at their disposal. The first one is the total assets turnover ratio. If you look at the word total assets turnover ratio, it is divided into two parts. One is total assets, and the other one is turnover. Okay. Now turnover is sales, and total assets are total assets. So it is given by the formula cost of goods sold by total average total assets. Means what is the ability of the company in terms of sales, and what is the total sales they have made in front of the total assets. So total assets should be less, and there should be more amount of turnover in comparison to the total assets. Okay. So for example, if the company's total turnover is 100 crores and the total amount of investment is in assets, total assets is considered is only 2 crores. Means with a total asset of 2 crores, the company is able to have a turnover of 100 crores, which is very good, because 100 crores divided by 2, the answer is 50. 50 times they are able to convert the total assets into sales. Next one is fixed assets turnover ratio. Fixed assets turnover ratio is sales by fixed assets, or cost of goods sold by fixed assets. I told you why we use the word cost of goods sold in the previous video. So you have land and building, plant and machinery as fixed assets, and let's take an example of machinery. With one machinery, how much you are able to produce the goods is what we are going to measure, because after you produce goods, you are going to sell, and after you sell the goods, you are having generation of revenue. After generation of revenue, because cost is controlled, there is a profit. Because of profit, the earnings per share will increase, and because of earnings per share, you will have a lot of scope for paying good amount of dividend. So if your fixed assets are less, and in comparison with your fixed assets, you are having huge amount of turnover, then the company is to be a very good company. So let's take a small example. With the machinery, what we have purchased, where we have invested our money, is 1 crore, and the turnover in front of it, by using this particular machinery, I was able to produce goods and then subsequently sell it, and the sales were to the tune of from 2,000 crores. So with the help of 1 crore of total fixed assets, I was able to have a turnover of 1,000 crores. So the total fixed assets turnover ratio is 1,000 by 1 is equal to 1,000 times. So 1,000 times you are able to generate turnover or goods you are able to manufacture in front of the fixed assets. In similar lines, we have capital turnover ratio. Capital turnover ratio is nothing but it's divided into two parts: capital on one side and turnover on the other side. Turnover is how much is the turnover you are able to generate or convert in front of the total capital what you have invested. Total amount of capital invested is called as capital employed in the business. Capital employed, as we have already seen, it is equity capital, retained earnings, or internal accruals, or retained profits, reserves and surplus, plus debt capital, plus debenture capital, plus unsecured loans, on and so forth. So everybody who is a part of the who has invested in the share capital of the company or the liabilities of the company or the capital of the company, they are interested to know how much is the total investment in capital and what is the turnover they have made in aligning with the total capital. For example, the total capital invested in the business is 10 crores from all the sources which just now I have read out, and they are able to have sales of some 2,000 crores. So 2,000 crores divided by 10 crores is 200 times. So on 1 rupee of your total capital employed, you are having 20 times your turnover in comparison with your 1 rupee of capital employed. So it's a very good ratio. Next one is current assets turnover. So current assets turnover ratio is again very important because you are investing your capital in current assets, and how much is the sales you are able to do because of the investment in current assets is also a way of analyzing how the situation of the company is financial. So the formula is cost of goods sold by current assets. Okay, if the current assets is 10 crores, that is the average opening and closing, and you are able to have a sales of some 5,000 crores, it means what? With a minimum current asset of 10 crores, you are able to have sales of 5,000 crores, which is 500 times. So higher the sales and lesser the investment in current assets is considered to be a very good proposition. Next one is working capital turnover. With how much of working capital turnover, you are able to generate sales. Working capital is nothing but current assets minus current liabilities. There is a separate session I will be conducting on working capital as we move into the next classes. So with minimal amount of working capital, whether you are able to generate huge amount of sales or not is what we measure from working capital turnover ratio. Working capital turnover ratio is given by the formula cost of goods sold by working capital. So cost of goods or sales should be high, and working capital is need to be very less. With less amount of working capital, you should generate huge amount of turnover. So higher should be the numerator and lesser should be the denominator, and the resultant figure should be very high. Next one. Let's look at the small problem. Then we can understand what is a total assets turnover ratio. So I will just read some two companies example in this case, and then we'll move to the next ratio. So here there are 6 companies. I will just read out the details of first 3 companies, A, B, C. The sales of all these companies is 600 crores, and the total assets, that is the total amount of money invested in total assets to produce these goods, are 10 crores in the first case, 550 crores in the second case, 200 crores in the third case, so on and so forth. So if you look at the first company with the help of 10 crores investment, they are able to generate 600 crores of sales. So total assets turnover ratio is 600 divided by 10 is equal to 60. So if you calculate on similar lines for company B, C, D, E, etc., you will get total assets turnover ratio in either of the cases 12, 3, 2, 1 and 0.5. So the first company is very good company because with the help of minimal assets, they are able to maximize their sales. So it is ranked number 1. So in the same way, last company is E company, which is having a turnover of only 600 crores in front of a total investment in fixed total assets of 1200 crores, which is in this case total turnover ratio is 0.5. So it is ranked as 6th rank or the last rank, and it is not performing well. They have to improve their sales in comparison with their total assets turnover ratio, or total assets, sorry, and or they have to reduce the total assets and improve their sales. Next one. Now, fundamental rule again for total assets turnover ratio, sales should be high. Assets, fixed assets or total assets are all the assets should be used effectively. With less assets, you should be able to generate more amount of sales, and the total assets turnover ratio should be high. Next one. Now we are talking about the most important part of our discussion, which are categorized as profitability ratio, as well as they are categorized under market value ratios. So please remember this set of ratios which I am going to discuss are categorized under market value ratios or market ratios as well as profitability ratios. Okay, so some of them I will read it out. First two you can has been already covered in the last video. Now we are going to cover the most important part of our profitability ratios, which are earnings per share, dividend payout ratio, earnings yield, dividend yield, price earnings ratio, and book value per share. Now, what do you mean by earnings per share? For every ratio which I have just now discussed or enumerated, we will have a separate illustration. Okay. Now, earnings per share. This earnings per share is the one which is used in stock markets or capital markets by the experts, by the researchers, to identify how the company is doing, how the company's profitability is, and earnings per share is one way of understanding how the company's position is, or whether I should invest in the stock market in that company or not, whether I should purchase the share of this particular equity share of this company or not. Okay, earnings per share is given with the formula profit divided by number of equity shares or number of outstanding equity shares. Dividend per share is given with the formula total dividend paid by the company by outstanding equity shares. Or there is another formula which I have not mentioned yet, but you can just note it down. It is face value into dividend declared percentage. Dividend is declared by the company in percentage terms. So you have to just multiply it with the face value of the company's equity share. So higher dividend, good is the company. Next one is earnings yield. Earnings yield is given by the formula earnings per share by market price per share. Okay, we'll have a illustration, numerical illustration on this one. So dividend yield also is there, dividend payout ratio, price earnings ratio, and book value per share ratio. All this we are going to discuss in the subsequent slides with the help of small numerics. Now let's talk about earnings per share. The first one. Earnings per share is given by the formula total profit earned by the shareholders of the company by number of equity shares. So there are some 7 companies in this example. The profit made by these companies for the shareholders, the equity shareholders profit is 600 crores in all the cases, and the number of equity shares issued by the company or the number of equity shares outstanding are 600 crores, 300 crores, 150 crores, 75 crores, so on and so forth. Please, I have forgotten to mention the number of outstanding equity shares in rupees crores. The figures are in rupees crores, in crores, not rupees. The number of shares issued are in crores. Okay, so now let's calculate earnings per share. Earnings per share is given by a formula profit by number of shares. So in the first case, it is 600 by 600 is equal to 1. In the second case, it is 600 by 300 is equal to 2. In the third case, if I work out on the same line on the same criteria, the earnings per share are 4 rupees, 8 rupees, 20 rupees, 30 rupees, and 60 rupees. Okay, so this is the methodology that is used for finding out the earnings per share. So earnings per share is 1 rupee, 2 rupees, 4 rupees, 8 rupees, 20 rupees, 30 rupees, 60 rupees respectively for either of these companies. Now let us understand which company has done good. Now earnings per share is nothing but profit made by the company, generated by the company, produced by the company per share. So profit per share should be high. So choose those companies where the profit is profit per share is very high. So if you look at this slide, automatically your hand will go, finger will point at the G company, which is able to generate 60 rupees profit per share. And the worst performing company as far as profit per share is the A company, which is able to generate only profit to the extent of ₹1 per share. एक शेयर के पीछे वो प्रॉफिट ₹1 कमा रहा है, दूसरा कंपनी ₹2 कमा रहा है, तीसरा कंपनी एक शेयर के पीछे ₹4 प्रॉफिट कमा रहा है, and the last company is producing a profit of 60 rupees per share. So as an investor in stock market, if I want to buy a company share, I will look at that company whose if earnings per share is high, so automatically G company will be selected. So this is the importance of earnings per share. Next slide, dividend per share. Now dividend per share is calculated as we will discuss. So first you will have data on face value, and subsequently you have data on dividend declared percentage. From these two data you can find out the total dividend per share. Total dividend per share. Okay. In this case, in this example, there are 6 or 7 companies, sorry, and the face value per share of all these companies is 10 rupees per share. The face value is ₹10 per share. And the companies at the end of the financial year, they have declared a dividend. The dividend declared percentage is 600%, 300%, 150%, 75%, 30%, 20%, and 10% respectively. Now, we will calculate as required dividend per share. Dividend per share, as I have told, it is face value into dividend declared percentage. So in the first case, it is 10 into 600 by 60, 600 by 100 is 60 rupees. In the second case, it is 10 into 300 by 100 is equal to 30 rupees, and so on and so forth. So the first company has declared a dividend of 60 rupees per share. The second company has declared a dividend of 30 rupees per share. And the last company has declared a dividend of 1 rupee per share. So as an investor, which company I will choose? I will choose that company which has declared the highest amount of dividend per share. So in this case, 60 rupees is the dividend declared by a company, which is the highest among all the companies. So higher the dividend declared by the company, best is the company for my investment purpose. So I will choose A company, and G company will be ignored because it is the company which has paid me less, which is going to pay me less amount of dividend. Next one. So we are now going to talk about dividend payout ratio. Dividend payout ratio is nothing but out of the total profit what they have made, how much is the dividend declared from the total profit. For example, your father has got a salary of 50,000 rupees, and out of this he gives you 2,000 rupees as a pocket money. So out of 5,000, 2,000 is given. That is, the payout is only 2,000 out of 50,000. So similarly, if I have the same logic for these companies, how do I find out dividend payout ratio? Dividend payout ratio is the relationship between dividend declared from earnings per share, or earnings per share, how much is the earnings per share and how much is the dividend declared by the company. So there is a correlation, positive relationship between earnings per share and dividend per share. If the earnings per share is good, then only the company will be able to pay good amount of dividend per share. Now look at the all of the cases. In all the cases, earnings per share of all the 7 companies are 100 rupees. Okay, and the company has declared a dividend of rupees 100 in the first case. In the second case, 70 rupees, so on and so forth, 50, 30, 20, 10, and 5. Now, in the first case, the earnings were 100 rupees and the dividend also declared was 100 rupees. So earnings were 100 and they told that yes, we are giving you 100 rupees dividend. Means 100% dividend has been declared. That is the formula for dividend payout ratio. Dividend payout ratio is equal to dividend per share by earnings per share. 100 rupees by 100 rupees into 100. Whatever the company has earned per share, they are paying in the form of dividend. 100% they have paid. In the second case, out of 100 rupees, 70 rupees is being paid. 30 rupees has been retained. Means dividend payout ratio is 70 by 100. That is equal to 70%. In the fourth case, 30 rupees is the dividend declared out of 100 rupees what they have earned. So 30% is the dividend payout ratio, 70% is the retention ratio. In the last case, 5 rupees is the dividend declared out of 100 rupees. So it is 5% only. Dividend payout ratio is 5 rupees, and the remaining 95% has been 95% has been retained by the company, which goes to reserves and surplus and added back to reserves and surplus to equity share capital, and that will become net worth of the company. So I will choose automatically those companies which are paying, whose dividend payout ratio is very, very high. Higher the dividend payout ratio, then I said consider that these companies are magnanimous, generous in declaring dividend from their profits what they want. So the first company is the fittest company, good company. B company is only paying 70%, so on and so forth. Next one, earnings yield. Earnings yield is nothing but the formula is given in front of you in the slide. Earnings yield is equal to earnings per share by market price per share. For example, look at the company A. Okay, the annual earnings per share is 200 rupees. Means the earnings per share after 365 days of rigorous hard working, the company is able to generate a profit or earnings per share of rupees 200. And sometime back I had purchased it for 500 rupees. When I went to the stock market, I purchased one share of this company for 500 rupees. Now the total investment of I have invested 500 rupees in this company, and on each share the company is declaring reporting a profit of 200 rupees. So one share I purchased at 500 rupees, and their the earnings is 200 rupees. In the second case, the market price is 70 rupees, and they are reporting a earnings per share of 200 rupees. In the third case, I have purchased one share at 1000 rupees, and the earnings per share is 200 rupees. In the last case, 3000 is the market price at which I have purchased it per share, and purchased only one share, and the earnings per share reported by the company at the end of the year is 200 rupees. Now automatically this can be also converted into ROI. 500 rupees on 500 rupees the profit is 200 rupees. On 750 rupees the profit is 200 rupees. On 1000 rupees the profit is 200 rupees. On last company 3000 rupees of investment the profit is 200 rupees. Now let's calculate earnings yield. Earnings yield is 200 divided by 500 into 100. That is earnings per share by market price into 100. So in the first case it is 40%. So if I do the similar kind of calculation for the rest of the companies, the percentage of yield, the earnings yield percentage is 27% in the second case, 20% in the third case, and in the last case it is 7%. So yield, earnings, yield all should be high. Higher the yield, better is the company. So in the first case, the company is earning 40 rupees per share on an investment of 100 rupees. On 100 rupees, 40 rupees. In the second case, on 100 rupees, the company is able to earn 27 rupees. And in the third case, 100 rupees is the investment and 20 rupees is the returns. So which company is good? A company which is reporting higher earnings yield, that company is to be a very good company. So automatically, A company is very good in my portfolio as compared to the last company, which is E company, which is having earnings yield of rupees 7% only. Next one, dividend yield. Dividend yield. Okay, today, assuming that I have purchased one share of Infosys at 500 rupees. Before I go into the slide, I'm just giving a small illustration. I purchased one share of Infosys at 500 rupees in the stock market from the stockbroker, and the company declared at the end of the year some 20 rupees. So now let's calculate dividend yield. So on 500 rupees of investment, the company is declaring a dividend of 20 rupees. Means it is 4%. How did I get it? Dividend per share by market price per share into 100. That is 20 by 500 into 100. 20 by 500 into 100 is 4%. So dividend yield should be very good. Then it induces me. I will be interested in investing in this company share. Okay, let's look at the small example in front of us. Okay, I have got 6 companies. The company's market price at which I have purchased each share is 500 rupees. I went to the stock market of EA. I went to the stock market, purchased a company A share 1 unit, B unit 1 share, C unit, so on and so forth. Each were purchased at 500 rupees. Now the companies are declaring different dividends at the end of the year. First case it is 100 rupees, second case it is 70 rupees, third case it is 60 rupees, fourth case it is 50 rupees, fifth case it is 20 rupees, and the last case it is 10 rupees. So if I look at the first case, on 500 rupees what I have invested, and they are giving me 100 rupees as dividend. So the rate of return is 20%. In the second case, 500 rupees is the investment per share, and they are giving me a dividend of 70 rupees per share. So it is 14%. And if I go like this and go to the last company, 5 rupees is the procurement price or the market price at which I have purchased, and they are declaring a dividend of mere 10 rupees. So the yield works out to be 2%. So which is the best company? The best company is A company because the returns in the form of dividend yield is 20% in case of A, and in last company is the F company, which is giving me a mere 2% dividend yield. Okay, so again I will add some more masala to this. Okay, 500 rupees is my investment and 100 rupees is the dividend they have given me at the end of the year. So it will take another 4 years to get back my total investment what I did. So the payback period is 5 years. What did I get? 500 divided by 100 is equal to 5. So you can do the payback period also similarly in all the other cases, and whichever is having the lowest payback period, that company is to be considered to be a very good company. Next one. Next one is price earnings ratio. This is famously used in stock market investment purpose by researchers, financial researchers or investors. So price earnings ratio. Price earnings ratio is market price per share by earnings per share. Okay. I have given a small example in front of you. The B, C, D, or E, F are the companies in our example. The earnings per share in all these cases are in front of you: 100 rupees, 70 rupees, 60 rupees, so on and so forth. And the market price is 500, 500, 500, and 500. Now, price earnings ratio is given by the formula market price by earnings per share. So, market price in the first case is 500 rupees, and the earnings on this is 100 rupees. So, I will be able to recover my investment within 5 years. Our price earnings ratio is 500 by 100 is equal to 5. In the second case, price earnings ratio is 500 by 70 is equal to 7. Means it will take 7 years to get back what I have invested. Our price earnings ratio is 7. In the third case, I have invested 500 rupees. They are paying me 60 rupees dividend, and our price earnings is 8. That means it will take 8 years to get back what I have invested. So if you look for the other companies, you got price earnings ratios. So price earnings ratios tells us which is the company which has the potential to grow, and which has the potential to reward me substantial. So the first company is the best company to as far as PE is concerned, because it is having a low PE, means the price is available. The price at which it is available is very, very attractive, because on 500 rupees of investment, they are able to generate, or they are reporting an earnings per share of 100 rupees. So there will be a lot of demand for this particular share in the stock market, and in subsequent time, in the times to come, the market price of the share will increase. So when the PE is low, that is the time for any investor to invest. When the PE is very high, it is the time to just get out of the stock. So in the last case, on 500 rupees of investment, the company is able to report a profit of 10 rupees per share. That is, the earning per share is 10 rupees. So just avoid it. Last one is book value per share. Last one is book value per share. Now, book value per share is nothing but in the first video I showed you what is the net worth of the company. Equity share capital plus reserves and surplus is called as net worth of the company. Equity share capital plus reserves and surplus are called as the net worth of the company. Okay. So in this case, I have for all these companies, 7 companies. If you look at the fifth row, sorry, the net worth of the company is given to you. The net worth is given to you. It's 51 lakhs, 62 lakhs for B company, C company, it is 73 lakhs, so on and so forth. So net worth of the company divided by number of shares will give you the book value of the company. So number of shares in the first case is 10,000, second case is 20,000. The very first row you can see the number of shares issued by the company are 10,000, 20,000, so on and so forth. So when you divide net worth of the company by number of shares, you will get to know what is the book value per share. In this case, the book value per share is 510, 310, 243, so on and so forth. Okay. Thank you very much for patience listening. And if you have any doubts, the mobile number is there, the very first page. You can put your doubts on my WhatsApp, and I will get back to you. Thank you so much.